Today I am going to take up the remaining financial statement and will briefly discuss about cash flow statement. In the last lecture, I discussed in brief about two types of financial statement, namely income statement and the balance sheet. Cash flow statement is very important statement in the sense that it tells us about the health of a company from its operations. We'll see later on why there is a need to have a separate cash flow statement. An income statement tells us about the profitability of a firm and so on. Once I have gone through cash flow statement, then I will briefly introduce to you about the ratios, assuming that in the first year you've already done. So I'm not going to tell you about the calculation, just I will briefly go through various types of ratios which are there and what are its implications. You know that if you look at the accounting, accounting, there are certain conventions which are followed in accounting. One is called accrual method. Accrual method is that if, for example, any expense or any income, for example, account, let us say, receivable. Now, whenever a good is sold, naturally cash is not realized immediately, but it is recorded in a statement as receivable. And you know that receivable may be that the credit period may be 160 days or 100 days, whatever is the day, it will be realized after that. But the moment the sales is conducted, it is recorded as receivable, which is not a cash. This is a convention which is followed. Second thing is, there are certain items which do not result in cash outflow, yet they are subtracted from income statement, like depreciation. That when you arrive at the taxable income, you subtract the depreciation. Depreciation is an expense for the long-term, expenditure for assets. It is written over a period, the life of the asset. Whatever method is used, it is up to the company to decide about what type of method to use it. So depreciation is a non-cash flow. It does not result in any cash outflow, but it is subtracted from. So what is done in cash flow is that we add certain items and we, for example, let me give you another example. Like certain, there is also a principle which we call amortization, like a goodwill of certain, so which is written over a period of time. So it does not result in any cash outflow, yet we subtract from the income, from the revenue to arrive at the taxable income. So what is that? These are added back, in the income, and then there are certain like receivable. It will be subtracted from that. In contrast with this, if there is a payable that the company has to make payment over a period of, after certain period, it has not resulted in a cash outflow, but in accounting statement, it will be shown as negative entry. That is, you have to pay it. So that is why here receivable results in, payable means that as if the supplier has given you credit, so it does not. So we add back and we subtract from this. Certain adjustments are made here, and cash flow statement has three components. One component is we make adjustment like this, like depreciation we add back, and receivables, is subtract, and payables are there. That I will show you exact some of these. Then investment activity. For example, the company may have made capital expenditure in assets and others, or in the other securities. So there is another cash flow statement which is investment activity, and then there is a third one, that is financing. For example, a company may have issued equity share, so it will receive cash, or it will result in a cash inflow. Similarly, a dividend may have been paid, so it will result in interest payment. These are cash outflow. So if you look at the word, it simply means that in reality, how much cash inflow and outflow is there during a certain period of time. Now let us see some of these. Like in this here, what happens that, from sale, from the return on loan, for example, if you have made investment, then it is added back. Similarly, if certain income has been received further from dividend income, cash outflows are like these, like to pay suppliers for inventory and employees for services and so on and so forth. Then there are certain items like cash inflow. For example, if the assets has been sold off, then it will result in inflows. Similarly, if the debt has been sold off, so it will result in. Similarly, if the capital expenditure has been made, then it will result in property, plant. Similarly, if certain other the asset like debt and equity have been purchased, so these are investing activities. Then there are other activities like how firm raises fund, and for example, through equity or the debt, firm may receive fund. So these are shown here. From borrowing, but will result in the cash, the inflow. Similarly, outflow, the amount which is borrowed, paid back, repurchase of firm's equity. In sometimes companies repurchase, buy back their shares. So for that, they pay back. Share dividend is paid like that. So what happened that when we, this item, and this item, finally, when we add together these things, it result is called the free cash flow after adjusting these. Now, this is important in the sense that like some of these things are given here. That this is not accounting class that I will teach you how this is done. Like a decrease in asset, naturally, if you sell it, it will result in inflow. If you purchase something, it will result in outflow. If liability has increased, you have borrowed, it will result in cash flow. The same transaction principle which you have, Professor Javed Akhtar must have told you. Here will come. So these are some of the adjustments which are made, is given in my slide. Why cash flows are important? The reason is that cash flow statements are very difficult to manipulate, unlike other statements. Like sometimes, different methods are used. Inventory valuation, depreciation. So there is in other statement, there might be some fudging. For example, what kind of method is used, and depreciation, what type of method. Because of that, what happens that other statement, there might be some spin, some manipulation. Whereas in cash flow statement, there is very difficult to manipulate. Sometimes what happens that some companies, they put it in something, some activities and operating or financing, like for instance, the depreciation in financing statement, if capital expenditure is made to purchase by company, it will result in outflow. So in finance, in the investment activity, it is shown here an outflow. Whereas in income statement, what is done is that it is written, this expenditure is written down over a period of time, as an expense. So that is why we add back this. It is the but here it will result in the capital expenditure. What is the amount which company has So it tells us about the well-being of the company. For instance, if a company, just 1 minute. Anyway, I think that slide is missing from here. Anyway, I will explain to you. For instance, there are three. One is operating cash flows. Now, if you find that operating cash flow of a company is not positive, then it means that the company is not able to generate enough cash from its current operation. So what it has to do? It has maybe using financing, maybe borrowing. So that is why the well-being of a company can be gauged from its operating cash flows. If a company is not able to generate enough cash, then it means that there is something it cannot sustain over a longer period of time. So that is why when it is negative, then it will be naturally positive because you have to borrow it, investing. That is finally when we arrive at it shows the free cash flow. And if you take the balance sheet of two period of time, the change in the cash will show you the cash flow of free cash flow. What has happened during certain period of time. The cash entry in a balance sheet will tell us about the actual cash. So that is why operating cash flow is very important because a company if you're running negative cash having a negative operating cash flow, it means something is wrong. So it has to borrow it. For example, like if you are not able to generate enough cash, and naturally like maybe company, maybe a government, one has to borrow it. So it comes from the financing activities. So you raise it. So that is why cash flow statements are very important. And in this we will see. Then apart from cash flow statement, there are certain ratios also. Why financial statement is important is the reason is sorry for interruption. So the what happens that when you are looking at the performance of a company, then one can look at the over a time period, how a company has performed from let us say 2018 to 2022. So we can look at this is called the time series, the performance of the company over. Then another thing is that the performance of the company can also be looked from in comparison to its peers in the other company, similar firm in a particular. So we try to look at if this is the company, then how the other companies are performing in comparison to which are similar. Not that you are comparing a company which is in food industry with the IT industry. Not be feasible. Or even in food, we have to make some finer distinction as well. So, you are comparing a company which is in retail business with the airlines. So it will not be. So that is why it provides us the idea about. Then apart from these financial statement which are very important like cash flow and other, these are helpful in also calculating certain ratios. Certain ratios based on these statements which are drawn from income statement and the balance sheet, which tells us about the performance of the company. Some of these ratios are like questions like that, like what is the profitability of investment in real estate? Naturally, when a company is using fund, like in balance sheet, when we showed it to you, that capital plus liabilities and then assets. So these were the sources of funds and there were uses of funds. So if you are how you are using this fund, from you are raising the fund and how you are using it. So in real estate, basically company will make investment in plant, machineries, equipment, other things. So some ratios like how much is return on assets, how much is return on equity, how much return on capital. And economic EVA is a concept which is which takes account the entire cost of capital, what we call economic profit, which are how, in other words, whether the assets are used efficiently, like some ratio like turnover ratio, about the profitability of what is the profit margin. Then financing, for example, if your financing is that whether you are using too much debt, and then question is how much is the debt ratio, debt to equity ratio. If you are using too much debt to equity ratio, it may be very risky. And for this, we have certain ratios like what is the interest coverage ratio out of the current income, how much interest is the safety is provided. Then another question is about the liquidity. For the short-term operation of less than 1 year, current, like net working capital, how much is the current asset and the current liability, and then certain ratios, current ratio, quick ratio, and cash ratios are there. So this tells us about the company. Like some of these questions are how liquid is the firm, like liquidity ratio we look at. How the firm has financed the purchase of an asset, capital structure, like how much debt equity, like I have told you, this ratio. Efficiency is like the turnover, the asset turnover. For example, if you have made a huge investment and contrary to that, what is the profit margin and like that, whether you're using those assets the efficiently or not. Then what is the profitability ratio? What is the profit in comparison to the, for example, if sale is very high, profit margin is low, but other thing can also tell us about the company. And then are the firms creating value for shareholders? For example, there is a book value, that is the book value of an equity, and market value. And market value actually is the expectation of the investors about the future performance of the company. So whether we are adding, for example, if the like various indicators like ratio, market value to book value tells us about that. So based on this thing, there are various types of ratios which are there. For example, the current ratio is current asset divided. It is given a higher current ratio, any greater than the will be better. But please keep in mind that it may vary from industry to industry. For example, for example, there will be no inventory in a service firm. So we have to keep in like some benchmarks are there, but these benchmarks may vary according to industry. Account receivable, the average collection period, how quickly one is covering, all explanations are given. Inventory turnover, cost of goods sold and the So higher the turnover, the more the investment and the more liquid the investment. Similarly, total debt upon total ratio, then in net operating income, how much is the interest expense. So, so that tells us about the ability to pay interest from. So all these are explained. What are the meaning of these two? Sales upon turnover ratio, and I'm just quickly going through with the assumption that you've already studied, and I know that it is taught there in the first year. Say, sales upon total asset, measure the firm's efficient use, sales upon net plant and equipment, fixed asset turnover ratio. Then certain other ratios like gross profit margin, gross profit minus sales, net operating income. This is also, for example, it tells us the markup, meaning how much, for example, from the earning, we subtract the cost of goods. It tells us about the markup is 10%, 20%, 30%. And then other expenses are subtracted from that. Then we arrive at operating income. So this tells us about net profit margin. After subtracting all the, apart from in addition to the cost of goods, other expenses. Then return on equity, how much is net income divided by the common equity, that is the number of shares which are there. Then certain other ratios which tells us about the market value, like market value per share, earning per share, like which we call P ratio. Higher the P ratio, more the company is expected to future earning. Similarly, market to book value is also an indicator of the valuation which this comes, because this is the traditional in accounting. We take the book value maybe 10 to P, but market value may be higher. So naturally, with higher ratios, there is a value addition. That is, so all these ratios are there. They tell us. Now, just an idea about, just so like some of the example, like if you look at the industry, food, product, retail, consultancy, chemical, you see that there are huge variation here. Like here, operating profit margin is 10% to 3.6 retail trade. It is very low, but the margin, the volume is very high. And you see that the turnover, retail trade and all other things, you can see that there is a huge difference across. Debt, long-term debt ratio, how much debt and equity you, and current ratios, for example, and other quick ratio. So pharmaceutical company, machinery. So there are, across, there are differences. We cannot compare a machinery, a company, electrical, a motor vehicle, to a company like food product. So there are variations, across, and that is why whenever we are comparing it, the ratios, then we have to, for example, if you see the profit margin, as low as this and as high as 15% almost in the pharmaceutical on an average. So manufacturing, it is very high, and so that is why various, for example, if you look at the turnover ratio, receivables and others, food product, asset turnover, return on equity. So there are so many things which have to take into account. Now, lastly, just I would like to tell you, this is also taught in the first year. There is a concept of return on equity. That is how much return equity holder get. Now, this ratio is calculated. The net income upon equity, but this ratio is made of three important components, which is not the company viewpoint, which is popularized. But now this ratio, number one is net income divided by sales. This tells us about what is the profit margin. Then there other ratio is sales upon total asset. This tells us about how efficiently the assets are used. And the third is total asset divided by equity. This is equity multiplier. Now, if you so finally, what will happen that this ratio comes out to be net income divided by book value to market value. So, but the return on equity is made from the net profit margin multiplied by the asset turnover and equity multiplier. So this is a very important, that these three, this tells us about the operating efficiency measured by profit margin. Second is that asset use, total asset turnover, and leverage, how much debt and equity, as measured by the equity multiplier. So that is why ROE is one of the very important indicators of the performance. And this is, as I said, that the ROE is, if you get these ratios, these you multiply by these three, then you will get the same thing either way. So these are some of the measures of the ratios which are helpful in understanding the performance of the company. And so it is explained here, one thing we know about that, company is like the growth rate of the company. So if you look at this, I have already told you that how much. One is the profit margin. If you have getting high profit margin, so one can, use internal funds, And then dividend policy is important. How much out of this earning, how much dividend is paid, and how much is retained. This retain means that you use the money for retention, for long back for further investment, and then how much debt equity is used. And the finances becomes available like debt, and how efficiently we are using the assets. So these are the determinants of long-term growth rate, like in dividend discount model. When I told you that in order to value a firm, you need, the required return are by growth. So growth, one of the factor of return on equity is, if we try to, how much is the retention ratio, the payout ratio. So multiplied by, for example, if a company is using 70% of its fund for, for plowing back, and return on equity is 0.5, then we can find out how much will be the growth of the company in the future, whether it can sustain it or not. So that is why growth of the firm, which is very important, so one can look at the profit margin, the turnover ratio, the use of debt and equity, and the dividend policy. For example, new companies which have got, you may recall that I was discussing about life cycle of industries. Like in initial stages, when a company has got in any industry which has got the profitability, it may not pay dividend. It may reinvest the money, but later on, when the profitable opportunities are not there, it may pay back. So that is why these ratios are very important here. And let me just show to you some other thing. And just I will share to you some other thing. Like there is various sites are there, like Yahoo Finance and other. For example, there is a site, screener. For example, if you want to know about the performance of a company, let us say I type it Infosys. Okay. Now you see that here the company's market cap, is stock P ratio, return on capital employed is shown here, and you can also find out profit and loss account, like sales, for example, from 10,000 to, like, there are various sites. This is one of the sites I'm telling you. So sales minus expenses, expanded further, sales growth, expenses, manufacturing, other car, operating profit, then the profit before taxes, net profit, earning per share, dividend payout ratio, compound, all these are given. Okay. Then balance sheet, share capital, liabilities, investment, and then cash flow. like cash flow from operating activity, receivable, payables, then working capital changes, net cash flows. So these are from cash flow from operating activities in investing activities. Fixed asset purchase, fixed asset sold. So the purchase means in negative it is shown here. Sold means that you will receive it, and investment purchase minus and so on. So from all these three activities, this is the net cash flow. If you see here, cash flow from operating activities, you see that in the this year it was, now you see that the company, from the here it was a positive, just 1 minute, cash flow, just 1 minute. Cash from operating activity, you see that these are some all positive. Okay. So it means that the firm is able to, and then investing activities and other activities are there. And now you can also see the comparison peers. What are the other companies in comparison, like TCS, Infosys, Wipro, HCL. So one can, the quarterly results are also available of all these companies. So comparison can also be had by this, of these companies. And so one can look at compare also. Some of the important companies almost debt free, completely equity almost, has a good return on equity, 25, has maintained a healthy dividend, 54 point, stock is trading 10 point book value. The company has delivered a poor sales growth over past 5 years. The sales growth of the promoted holding is very low, 13 normally in India we find. So so one can find plenty of information about these things and can use this information, and documents also one can find out, like you can find out the annual reports and other things of the company and other documents which are there. So so in this way, information, and that most of the ratios are calculated. Yahoo Finance, you go there, you will also find these ratios and other things. Only thing is that you have to interpret these things, So this was just I wanted to show to you that how can you access these things. Now, if you have any question, you can ask before I proceed further, because time is very short, and time is very, very short, and we have to complete it. I can see some people who has joined for the first time. I have complete record of that. Who are these people? If time had permitted, I would have taken up these valuation of companies in more detail, but since time is not there, so I am constrained to take it. But I have shown you that in this way, you can, using your knowledge of first year, you can understand.
So, sir.
Yes.
So I have a question regarding that return on equity formula we were using. So my query is regarding that if we use a book value of a share in calculating the return on equity, it wouldn't give us a fair value, because the market value is many times, mostly it is higher than the book value. So how can we get a fair picture?
Who is this? What you are saying, that you are correct in the sense that return on equity, but that gives us an idea that what rate the company is able to the like that. But that in the valuation of a company, return on equity is not the only factor, isn't it? We, in the valuation of a share, we have in the valuation of a company, if you look at the formula for whether what is the if a company is paying this much, and then there is also a formula which tells us about R. R is actually the required rate of return, isn't it? So company is giving this much, and if you calculate via that, then R minus G, that is the growth rate when we calculate of the that how much the money invested in will grow in the company, and R is the required rate of return. So naturally, in valuation, we bring into that. You are correct in the sense that the naturally the return on equity, but it gives us that at the what rate the company has provided at the. But at the same time, we also expect in the return from the company, and that is R. So if you look at the formula, uh, so that formula is R minus G. So that is the R is always greater than G. If it is not there, then the formula will not. So that is why we use that. But that is not the. And moreover, another important thing is that when you are valuing a company, then there is a the relative valuation is there. P ratio is also there. It is not that ROE is the only thing which is used there. ROE just gives an idea about at what rate, what is the sustainable growth for the company. And at least the company can grow at this level. Beyond that, that the so, and valuation is not based on the past. Valuation is based on what rate a company will grow in the future. So that is why that is a the threshold with which is started, but the required is much higher than. If you revisit the formula for the equity valuation, you will find that that is why in the denominator this is taken care of. That is the R is always greater than G, that is required.
Okay, okay, sir, understand.
So I think that I do not know how much you are able to understand the accounting, but I have also my own constraints. That if I go on teaching these things to you one by one, everything and calculation, which is not, then it will, I will not be able to take up the finance aspect, or mostly I will be dealing with this thing. But just I wanted to discuss with you and show to you what are the important slides will be given to you. By today, I will supply most of the slides. Now, I am moving into the last unit. That is the last unit deals with the portfolio evaluation, portfolio performance evaluation, and the options and the theory of active portfolio management, and something about global portfolio diversification. Now, if you recall that I was discussing about when I discussed about the investment process, then I discussed about that there are various steps in the investment process. Like if you take this diagram, investment objective, then slightly modified version, but conveys the same thing. Use the delineation of the objectives and constraint, then asset mix, how one is going to, debt equity in asset class, gold, and this and that. Then you choose a portfolio strategy, then how much 30% in this equity, 50% in bond, and like this. Then out of that, we choose certain type. For example, if you say that 30% in equity, then the 33,000 shares are there. So out of that, you have to choose, how many companies, maybe 20, 30, you have to do the analysis by using the analysis, fundamental analysis, which I just discussed with you. You can choose and for that. And then portfolio executed, and then maybe the revision also takes place, because sometimes it happens that you set out for a portfolio, but the price is a bit higher or something like that, or some other changes are there. And then the last point here is that when you have made investment, then you have to evaluate the portfolio, how good or bad it has performed against the objectives, against the return which you have set out. So today in this part, what I am going to tell you is about various portfolio performance measures which are used for arriving at the evaluation of the portfolios. And when I say portfolio, it may be performance of a portfolio, or it may be performance of a mutual fund, which is again a portfolio. For example, if you want to know about the performance of mutual fund, then one can use it, or performance of a security, one can use it. And all these methods which I am going to discuss are based on the model which I have already discussed with you, known as CAPM, Capital Asset Pricing Model. So let us go through this thing. So, but some history about evaluation. You know that the earlier before 1960s, and please remember that portfolio theory was developed in 50s, 54 Marco, and in CAPM was developed in the year 1964. So the portfolio performance was measured using only return. It was not discussed with the risk. For example, if there are two portfolios, A and B, 15% and 20% based on return. Naturally, 20% return, annual return, B has outperformed A. This is well taken. But the risk side, was not taken into account. Maybe it has provided a return, higher return, but it may have been risky. Let us say its a risk was 25% SD, and this was having a risk of 15%, 12%, just an example. So naturally, we have to bring in the picture how much this portfolio has performed based on risk-adjusted measure, not only return measure. Because return may be higher, but the portfolio may have been riskier. So that is why after the development of CAPM and other, now we have measures which can tell us how good or bad a portfolio has performed on risk-adjusted basis. And please remember this model which you will come across, CAPM. CAPM simply says that there is a relationship between risk and return. Risk is measured by beta for market risk. It is also measure of market risk, undiversifiable risk, and return and risk. Higher the risk, more the return. Then this model is used as a benchmark. That how much you should get. This formula comes in the picture, that return on any security or fund is equal to RF plus RM minus RF, that is the risk premium. This is multiplied by the amount of risk which is there. So in comparison to a market return, this is the risk premium, and like this. And so this measure has been used by this. And you may recall that when I was discussing about CAPM, then I told you there are two versions. One is called capital market theory, CML, and one is known as security market line, which is nothing but the beta and relationship. Here we have taken SD, that is standard deviation. So this was only relevant for efficient portfolios which are already diversified, and this was whether efficient or inefficient. So that is why if a portfolio is diversified, both the measure either you take this or will be same. So, and when we are looking at the performance of a mutual fund and other things, they are already diversified. And this equation, which I have just written here, form the basis of what we call it the alpha, that is Jensen's measure. For example, the return on any security is equal to risk-free rate plus the risk premium, the return on market minus risk-free rate without any risk, multiplied by the amount of risk. So this is, if a security is providing higher return than this, it means that it is generating a positive alpha. If it is providing a lower return, then it is negative alpha. For example, according to this equation, if the return is 14%, and a security is providing 16% return. It means that 2% more than mandated by this. So it is a positive. The Jensen's alpha, it's positive. But if it is, say, it is giving 12% return, it means that -2. It has performed, worse than what is prescribed by this. So as I said that these measures have roots in the model which I have discussed with you, CAPM and other. So you can go through. So the first measure is risk adjusted measure is Sharpe index, named after William Sharpe, the inventor of the CAPM. It simply says that return on a portfolio minus risk-free rate divided by the risk of the portfolio. How much return of portfolio has generated, let us say average return minus the average and Sharpe. For example, this is, we are scaling it with the return. This is the return and this is the risk. So we are scaling it by the risk. If there are two portfolios, so we'll take I and F. If there, then we will compare it, whether this ratio is higher than the other one. If it is higher, I is higher than J, it means that on risk adjusted basis, portfolio I has performed better than E. So then in the another method is Trainer method, named after Jack Trainer, who is also credited with the development of CAPM. So the numerator is same, but only difference is in the denominator, which is beta, which is nothing but the market risk. If a portfolio is there, then weighted average beta portfolio, for example, if there are 5 securities, the amount of money, 5 securities are there, and equally weighted is there. So the risk of that portfolio, the beta of that portfolio, 0.2 multiplied by beta of 1, beta of 2, and so on, weighted average of the beta divided by the beta of the portfolio. So numerator same, denominator different. Then the third method is called Jensen's alpha. Please recall that I have just explained to you that this is nothing but the CAPM equation. This tells us that this part, okay, risk-free rate plus the beta of the portfolio, return on market minus risk-free. So this is the risk premium. This is the beta, that is the risk of the portfolio, undiversifiable, and plus the risk plus the return without any risk. If a portfolio, we can find out the alpha, that is whether a portfolio has generated better return or lower return than this, by subtracting the return of portfolio from the return of as postulated, as given by, provided by CAPM. So in this way, we can arrive at these methods. So let us take an example to understand. These are, let us say these are 3 mutual funds, A, B, C, and like this. These are, let us say, monthly return of these funds. B, 30, and this is the return on market, that is the, let us say, Nifty or Sensex. And this is risk-free rate, let us say it is treasury bill or some other, virtually risk-free. So what we have done here is that the average return has been calculated of this, all this, and you are given the standard deviation of this is calculated from this. You can understand how can you calculate the standard, you know it. I have done already. And then these are the standard deviations. And beta has been calculated of 1. For example, we take fund A, the return of fund A, and return on market, and run a regression. This is a dependent variable, Y, and this is X. We run a regression, we find out slope or the regression that gives us the beta. That is the return, the beta of this portfolio is 1.2, that is higher than the market. The market will have a portfolio by default of 1. This is 1.92. It is less than 1. That is the less volatile than the market. And this is 1.4, slightly more than. And this is 1 naturally. And if you take X and also we take another one, that with this naturally it will be once you take it as a dependent variable and independent variable. So by default, I have already shown to you in my discussion like this. So this is how we calculate it. So regression through regression, these are calculated and provided to you. Okay. Now you are asked to find out calculate the Jensen trainer and Jensen Sharpe trainer and Jensen alpha. So what you will do that you will just take these returns, 17.1 minus risk-free rate is 18.6. Just there is, I'm sorry, there is some issue with this. If you divide by 17.1, the first method is RF RP minus, that is return on average return minus RF divided by the beta. One I will take it, other you can. Is 17.1 minus 8.6 is the risk-free rate divided by the beta. It is 1.2. Okay, the first one. So one can find out. So it will come out to be 7.1. This will remain same for every other. The other one is 14.2 divided by 0.92. It will come out to be this. Same way, 13.2 divided by 1.04, that is beta 4.8. And market, no need to do that, but you can do it. So you see that the higher this is performance is greater than this. It is mere coincidence that they are, in terms of performance also they are ranked from. This is the highest performing, and this is the next one, and this is the least the last one in performance. So using Taylor method. Now in the Sharpe method, denominator will be numerator will be same, 17.1 minus this, but we will look at the standard deviation, which is 28.1 here. So same way, numerator is same like trainer. There is no difference here. Only difference here is the denominator. So is the SD, that is 0.32, 0.29, 0.2. So naturally this is performance. This is 1, 2. And if you rank it, the best one, and in terms, it is also coincidence. Now the third one is that that the portfolio return is the risk-free rate is 8.6. Beta of the first portfolio is 1.2. Return on market is the difference RM minus RF is the 11. If you subtract this, it will be 2.4. So 11 and so it will come out to 5.62. So it is a positive. You can see here the 17 multiple. So all these are positive alpha generators, but in the higher the value, better the performance. So again, fund A is 1 in rank in performance like this. So in this way, we can have a measure of portfolio performance of the portfolios. And let me tell you that these are methods which are widely used for arriving at for measuring the portfolio performance of the funds and other, like whether, and there are books for alpha generation. Alpha generation means you can beat the market. This is what the market provides. So if you have performed better than the market, it means that you have generated a positive alpha. So normally what happens that if you look at the performance of the companies, then for example, if you have 50 mutual funds, so you will find that 4 or 5 maybe have positive alpha. And then again, we look at whether they are statistically significant or not. Maybe the positive, but statistically they may not be significant. So on an average, that is why we find that the mutual funds, they are not able to beat the market to that level. And that is why the debate is about whether active portfolio management and passive portfolio management pays, whether passive that like invest in a index and just hold it for some period of time, then you will swim or swing with the market and like that. So these are some of the methods which are, apart from that, there are other methods also like attribution measure, information ratio, then others are also there. And but I think that this is enough for you in this course, giving the time. So, so these methods are widely used and they for measuring the performance. Now a debate is about, as I just told you, whether when you are managing a portfolio and whether you should undertake active or passive portfolio. If you have any question about this thing, you can ask before I proceed. If you go to the various sites of portfolio performance, like value research and others, and where are you will find all these ratios which are there. They rank the mutual fund on the basis of the sharp pay trainer and because this tells us about that. For example, when they are these mutual fund managers, they are running these managing the fund, they are charging also a fee. And so that is why the big question is that whether they have performed better than the market or not. So they claim that if they are taking active portfolio management strategy, that is forming a portfolio and then executing it and revising it again and again, whether they can perform better than the market or not, like that. So that is why these measures tells us about their performance on risk adjusted basis. Now I will just briefly explain to you one more thing. This is related to a debate about active portfolio management and passive portfolio. As I told you just now, if you look at the performance of mutual fund and try to find out whether they have outperformed the market or they have done better than the market. So we find that there are very few mutual funds which they can outsmart the market or can beat the market, outperform the market. That is, they can generate positive alpha. So that is why the big question mark is that when these mutual fund managers, they charge very high fee and they are paid very handsome amount. So whether it is good to have a passive portfolio strategy. Passive portfolio strategy is like you construct a portfolio based on some index like Nifty 50 or Sensex has got 30 stocks. So you just form a portfolio of 30 stocks in proportion to the investment made by constituent Sensex. Like if XYZ company, the weight in the Sensex, the index is 0.05%. 0.05 means 5%. You also have a portfolio of 5% in that company in same way. So in other words, you mimic the portfolio formation in light with some index. This is called passive investing. You do not have to actively change. So now the performance of this index will down in line with the movement of the market. Because if you are trying to beat the market, that is, you are trying to outperform, this is market indicator of the market, where market is going. So, and by that instead of farming, you actively select 30 securities and form a portfolio, which what type of securities will compose these portfolios. So naturally, and then try to. So there is debate is that is why passive investing has been advocated, that it is cheaper, it is not very costly to maintain. And if you are trying to find active portfolio, then you are selecting 30 stocks and trying to find out whether some securities are undervalued or overvalued. You try to find out securities which are sold in the market at lower price than their value. You buy it, and then you have a diversified portfolio. So that is why there is a debate about, and debate is not, jury is still out about that. And this is what I said, that index funding, which was popularized by John Bogle, who said that there is no benefit in buying and selling actively. Rather, we should make investment in an index fund, and we should buy and hold that strategy. Whereas there are some people who believe that they can beat the market, they can perform, and therefore still there are who they take active, and they undertake this strategy by market timing. For example, if they think that the market will there will be an upswing in the future, so then they tilt their portfolio in high beta stocks. And if they can time, time means that you move in and out of the investment, anticipating the market movement. It may backfire also. For example, if you are moving it, the securities in line with the market, you try to time it. Because if you time it, because those stocks which are high, which have got high risk, then the market is, moving up, then you will reap the benefit. But it may go otherwise. So market timing is one method which is taken by that. Then they also rotate the investment according to sector. For example, certain sector IT and this, they try to shift their infrastructure and others according to they have their. So sector rotation is also used by active portfolio management. Then they also, try to find out securities which are undervalued or overvalued. It is given there in my slide, like classification of industries like industrial, financial, they tried, then consumer, industrial, growth, cyclical, stable. So by using, or some other like interest sensitive stock is stock to sensitive to exchange rate. So sector rotation is carried out like this. Then security selection is that you try to find out securities based on certain valuation techniques. And like dividend discount model is used, PE ratio is used, free cash flow theory is used, another method may be used, that those stocks which are undervalued, you buy it, and overvalued, you sell it. Then some specialized concepts are taken, like it is not, I think in my slide it is not given, let me explain to you. Like a small cap investment strategy, that you make investment in a small capitalization stock, and it has been empirically established that over the years in US, small stocks have performed better than the large market cap stocks. So that is why it may pay. Then certain portfolios based on book value to market value, certain portfolios based on momentum, certain portfolios based on P ratios, high and low P ratio. So these are some of the specialized concepts which are taken, and some other specialized concepts are like some take contrarian strategies. Those they make investment in a stock which have performed badly in recent time, with the hope that they will reverse in the future. That is why in India there are also contra funds, not many, but that they make investment opposite to the market. So that is why specialized concept can also be used, for portfolio formation, and that so that is active portfolio. But as I pointed out, that the debate is still there, whether the active versus passive, whether active portfolio management can outperform the passive portfolio management. There are little evidence that active portfolio management outperform passive management. But it does not deter the fund managers, in pursuing this strategy, because in out of 50, maybe 4 or 5 are lucky, so they try. So that is why the performance of mutual fund manager is the debate is whether they are based on luck or performance, or whether their performance can be attributed to their, I'm sorry, luck versus skill. It was because there is special timing ability, sector rotation ability, stock picking ability, and use of specialized concept, or it was merely a luck when that they found some and the investment strategy which paid off like that. So that is why, so it is very difficult to disentangle whether it is because of the skills of the manager or otherwise like that. Various techniques are there, and like at that point, we can know about the timing also, and we can look at the timing strategy, and we can even, for example, portfolio performance measure I have shown to you only 3. We have also a method whereby we can look at the timing ability, whether they have timed the market or not. So we can also empirically test that. So with this, I have briefly covered active portfolio management. Tomorrow when I start, I will briefly start with the global portfolio diversification. That is the portfolio diversification across other countries, and what are the arguments for and against that. So before I close for the day, I would like to tell you that you may have seen your assignment, which has been, the last date is have been given, and for the data of a beta and other calculation, you can visit Yahoo Finance or NAC or other website. You can easily get the data from there, either daily data or any company. And please remember that there should not be any tally with the. I will not consider it a coincidence if the 2 students are submitting the same assignment. So it should be out of those students, 39, 31, whatever the number. Today is 23 still. So it should not match. Otherwise, they will get 0. Because it will not be coincidence that one thinks about, there are thousands of companies are there. So you have to make sure, not that you consult it, but I think that if you go randomly, then I think that it will not, there will be not a chance. So you have to, and a test will be taken maybe next week. So minimum 25 marks, and the second assignment will also be shared with you with submission, because the date of exam is 16. So all these have to be done before that. If you have any question, you can ask before we close.